In this video, we're going to look at some actual analysis of financial statements. This is a skill that I think any manager, anybody working in business should have an understanding of this analysis. You don't need to be an accountant. You don't need to know how statements are even created. You just need a financial statement, and you need to know how to read it and then how to analyze the information that you can get from that financial statement. And of course, there is other data that you may need to help you along the way. So let's work our way down through. We're looking at, in this case, we're going to get a company. This company is Coca-Cola, and we're reviewing their financial statement. So here is the left-hand side of their balance sheet, which reflects the assets of the company. We also have the right-hand side of the balance sheet, which reflects the financing aspects of the company. We have their income statement, reviews the operations for the past year. We have some other data that we might need. Dividends certainly is important. Market price. Most of these things are not listed necessarily on an annual report, so we may have to go out and find them. So there are ways of, if you go to Yahoo Finance is a website where if you input the company's ticker symbol in the quote box, the company's web page will come up, and then you can, if you look at the labels, you'll see place says historical data, and you can gather data, both dividends and market price for the company. So before we get started, why are we even doing this, right? If you think about companies, right? Coca-Cola is a huge company. Compare that to another company, a much smaller company. Recently, I've had some Jones Soda. Jones Soda is probably a tenth the size of Coca-Cola. So comparing the sales of Coca-Cola to the sales of Jones Soda is just not a fair comparison. Likewise, if you look at their profits, look at the dollar profits of Coca-Cola compared to Jones, you can't say that actually Coca-Cola is doing a better job by looking at these absolute numbers. So we need to standardize the numbers to help us with making comparisons. So the idea of ratios is to try to highlight weaknesses and strengths. We're kind of looking for symptoms of problems. So how do we make this analysis? We can make comparisons between our company and industry. We refer to benchmark analysis is by comparing our company to another company. And all of this is done typically with the idea of a trend analysis. We want to look at history, right? How has the company been doing for the past 5 years? How's the industry been doing for the past 5 years? If our profits are declining, but the industry on average is increasing, that is important news. That's important information for us to know. But if our sales if our profits are declining and so is the industry, well, we still need to be concerned, obviously, but now there's a different piece of information that we need to look to try to figure out how we can improve operations of our company. So there are 5 basic categories of ratios. The liquidity ratio talks about, can we make our payments on a current basis? Asset management basically asks the questions about efficiency. Do we have the right amount of assets, or are we controlling our assets in an efficient manner? Debt management. what is the right combination of debt and equity for the company? We need to know how much debt we have. Then we can decide whether we want more or less. But we also need to understand the amount of debt that we have. Are we able to control and handle that level of debt? Profitability, there's a variety of things that we're going to talk about here. We're going to talk about controlling expenses. We're also going to look at how some of our income relates to other items. How much profit is generated based on our asset base? How much profit is generated given our investors money? And finally, we're going to look at market value, and market value ratios basically answer a question. Do investors like what they see? If these numbers are high or higher, then that implies that investors like the company and they're willing to pay for the profits of the company. So let's look at this first set of ratios, the liquidity ratios. Remember, this is about our ability to pay our short-term debts. Now, the short-term assets, current assets, right? That's cash, accounts receivable, inventory, some marketable securities, although cash and marketable securities are sometimes combined together. So this can essentially be referred to as the cash of the company. Divide this by the current liabilities. This is sort of like the bills. So the question is, do you have enough cash to cover the current bills of the company? This number hopefully needs to be greater than 1. A bigger number is better than a smaller number. We don't want it to be too big because we don't need too much cash. But again, higher numbers reflect greater liquidity. The quick ratio subtracts inventory from the numerator. Why do we do this? Inventory is the most difficult current asset to get rid of. So the quick ratio is just a more conservative measure of liquidity. And the difference between these two is obviously going to reflect on how much inventory the company has. So let's look at current ratio and quick ratio for Coca-Cola. Again, graphically, I think I like pictures myself, but you can see that the two items, they move in tandem, right? That with the exception of 2019, the current ratio was always greater than 1. So we're showing that we have an ability to pay our bills fairly safely, right? No challenges there. Now, for big companies, this really isn't a problem because they have a lot of sales that they're always going to have cash coming in the door. So this doesn't mean that the company is going to default on anything. This is just a red flag, if you will. It says, hey, take a look at this. You might need to pay attention to it. It doesn't mean that the company is not going to pay its bills. So as we look at the graph here, we can see that the lines for the ratios that we have here pretty much go in sync with each other. But we can see the what? In 2019, the current ratio went less than 1. Right? Now, that's a red flag. Now, this doesn't mean that they're not going to pay their bills. Big companies have constant cash flow coming in the door. So them not being able to pay the doors is not something we worry about. It is just a red flag. If it continuously was below 1, we may want to look at some issues. Some of those we'll talk about when we talk about efficiency, right? But again, it's just a signal, a sign that maybe there's something we need to look at. And as you can see that over the other years, it's always been greater than 1. So we in general say that, look, Coca-Cola should have no problem paying their bills on time. So that's the liquidity ratios. The next ratios to look at then are the asset management ratios. Now we can divide them into short-term and long-term ratios. So the short-term ratios talk about how, and just as a side, sometimes we refer to these as efficiency ratios. How efficient is the company in using its asset base to generate profits or sales? So DCI is days carry inventory. On average, how many days does inventory sit on the shelf? And of course, we would want this to be a little bit lower than higher because it reflects sales. But a higher number also reflects a large amount of inventory. So again, we need to investigate. If we think there's issues, we need to investigate. DSO is days sales outstanding, sometimes referred to as the average collection period, ACP. This is accounts receivable. How long, on average, does it take for our customers to pay for the things that they buy from us? Now, for large corporations, think about Coca-Cola. Coca-Cola doesn't sell directly to customers. They sell to grocery stores. So their accounts receivable reflect the debt that grocery stores and other types of distribution units have on the company. So again, we want to see how long does it take for them to pay on average. Now let's look at these two before we go on to the third one. So we can see that in general, we're in the ballpark. The day sales outstanding, the top number here, it ends up here at the end of 2021. We're basically at little bit less, 33 days. That seems pretty reasonable. It takes our customers take roughly 33 days to pay us. It was a little higher, but it's never been a terribly high number. What about days carry inventory? Again, if you look across the line, we're pretty steady, right? It has a little bit of an increase over the last couple of years, but in general, it's fairly flat. So what this tells us is the amount of inventory that we have sits on the shelf roughly 30 days, but it also doesn't change much. There's not a lot of variation in the amount of inventory that we hold. DPO, days payable outstanding, talks about how long it takes for us to pay. Now, when you look at this graph, it has a very important significance to Coca-Cola. It turns out 90 days was the least, and it has risen to 138 days. Now, why is this? I always have trouble with this ratio when you get it from companies, right? Because it typically seems to give us numbers that are just way too high. It doesn't make sense that in reality, accounts payable, that it is a very high number, 140 days. There's no way that Coca-Cola takes 140 days to pay their debts. So how I look at this ratio is I don't necessarily look at the magnitude. I look at the slope, and it appears that it's taking us longer to pay now than it did 4 or 5 years ago. So again, I worry about the magnitude of the number because it really doesn't make sense most times. So we want to take that with a grain of salt, if you will. And as we're talking about this, I'm actually thinking the reason for it might be right here, that we're using the expense cost of goods sold instead of sales. So that could be a reason, since cost of goods sold is going to be much lower than sales. So again, the number itself might not be as important as the direction or the trend for the company. Now, we also can look at long-term efficiency. We can look at fixed assets and total assets. The higher the number, the more efficient we are. So as we see here over the last couple of years, we've had a downward trend, but now it's starting to make its way back up. So what we can say that in general, again, we don't see a lot of change, relatively speaking, in Coca-Cola's use of plant and equipment to help generate sales. So the asset base seems to be steady, right? It's very closely related. There's the relationship here doesn't change much between sales and assets. When you look at total assets, you also see the what? It's a very flat curve. So really, the efficiency, however efficient the company really is, it doesn't seem to change much. So the company is maintaining its operations in a fairly efficient way. Now, would we like the numbers to be a little bit bigger? Of course we would. Given what we see, and just looking at Coca-Cola, I think we would have to say that at least we are stable. A good thing that we could maybe do is compare this to industry numbers over time. That would then tell us how we compare to some of our competitors. One other thing we want to take a look at here real quick is just a relationship on these short-term assets, right? So this is what's referred to as the cash conversion cycle. The operating cycle is DCI plus DSO. So this is the days carry inventory plus the days outstanding. What this tells us is how long does it take from the time we buy inventory to the time we receive money from our customers for the purchase of that inventory. That's what's referred to as the operating cycle. The conversion cycle, then, we subtract from the operating cycle how long it takes for us to pay. Now, we would like this number to be as close to zero as possible. That then reflects that what? We're paying for our inventory roughly about the same time that we're getting the cash. The cash represents profits, right? It's the entire sales. Take that entire sales number. Now you pay for the inventory. It kind of completes that profit cycle, if you will. So let's look at our cash conversion cycle for Coca-Cola. Now, one of the things that we had talked about is the DPO ratio, that for some reason it might be out of whack as far as magnitude, which obviously is going to affect our numbers here. But the cash conversion cycle, look, is negative, right? It's not terribly negative, right? But it certainly is reflective that we are taking longer to pay for our product than it is for us to get our sales. And again, we want this number to be as close to zero as possible. Even negative, a couple of 2, 3, 4, 5 days is not too bad. But once we get beyond maybe 10, 15 days, people are going to start to question, because the only way that can be negative is if we are slow paying on our payables. So again, I hope you liked the video. I look forward to talking to you soon. Bye-bye.